Good afternoon, everybody. Just because it is 12 o'clock right on the dot, we're going to give everyone else a few moments to log in just to make sure everyone who registers has a chance to jump on the call today. So, but at least for those who are here, thank you for signing on. Today's webinar is on the tax implications of an inheritance. So I hope you find this information useful. And if there are any other questions after the webinar today, please feel free to contact me directly. You can always go to our website, kkc-law.com, to get our contact information and also to get information on upcoming webinars that we're going to be having. This is a recurring webinar segment that we have. As some of you might be aware, if you've attended past webinars of ours, we have some more coming up later this month, or I should say probably starting again in November. So please feel free to keep up to date with that information on our webinar. And again, please reach out if there's any questions or if there's any future webinar topics you'd like to see down the road. We always welcome those, again, comments from you all. So please let us know, again, any tips for us or topics you'd like to see for any future webinars. So in the interest of time, everybody's time today, we'll get started. So as I mentioned, today's webinar is on the tax implications of receiving an inheritance. I'm also going to briefly talk about tax implications of to not only those beneficiaries receiving the inheritance, but to the person who's passed, because there is a related tax component there as well. So I'm going to address both of those topics, and I'm actually going to start there. So before we get into what taxes, if any, do beneficiaries of an estate have to pay, there is a potential tax that's going to be paid at the estate level by the person who has passed. And this is known as the estate tax. So Benjamin Franklin, one of his famous quotes is, what's the only thing that's certain in life? Death and taxes. And here's where that statement is particularly true. There is an estate tax that exists in Connecticut at the state level. There is also a federal estate tax. The good news is that this tax doesn't apply to the vast majority of people. And that's because you have to hit a certain asset threshold before the tax is going to apply to you. In Connecticut, that asset threshold that you have to hit is currently $7.1 million. You can see why not many folks have an estate tax problem living in Connecticut. I personally don't myself have an estate tax problem, although I wish I did. But it does still exist. So the estate tax is there. But again, if you own $7.1 million or less, the tax isn't applying to you. I should also clarify too that under Connecticut's current estate tax system, that amount is scheduled to increase. It actually started increasing a few years back. So even though in 2021, the Connecticut estate tax exemption amount is $7.1 million. Next year, as of January 1st, 2022, that amount is scheduled to increase to $9.1 million. And then even again, it's intended to increase in 2023, with the original intent being for it to be north of $11 million. So the big takeaway is that likely the estate tax doesn't apply to you, or if it does now, it might not a few years from now, just because again, that amount is scheduled, that exemption amount is scheduled to continue to increase over the coming years. So that's at the state level. There's also, as I mentioned, a federal estate tax. The federal government, at least for right now, is even more generous in their exemption amount. So in Connecticut, right now, again, the exemption is 7.1. The current exemption at the federal level for the federal estate tax is $11.7 million. So even fewer people are paying the federal estate tax exemption. And this is amount too, where just like Connecticut's is proposed to increase, although at Connecticut's proposed, at least under the current structure, to increase pretty dramatically from one year to the next under the next couple of years by about $2 million each year. The federal estate tax exemption is also scheduled to increase every year, but simply to keep pace with inflation. So for example, last year, under 2020, the federal exemption was $11.58 million. And again, to keep pace with inflation this year, it was as of January 1st, it was increased to 11.7. So it goes up a little bit, but not as much as we're seeing currently at the Connecticut level. I should mention that there's currently federal legislation it hasn't been enacted. It's still being debated at the federal level, again, in terms of what the final proposed legislation is going to include. But one of the big takeaways, or big pieces of that proposed legislation, is a reduction of the federal estate tax exemption. So again, right now, the federal exemption is 11.7. Under the new proposed legislation as it currently stands, the most recent iteration of that, they're proposing to reduce that exemption back down to $6 million, which would be even lower than the current Connecticut estate tax exemption. So it's unclear if that is actually going to be implemented under the final legislation, or if maybe there's going to be reduction, but whether that's the specific amount they're going to go with. Again, all of that, it remains unclear at the current time, but we are letting our clients know it is a possibility that the federal exemption could be dropping at some point in the near. And actually, too, I think what they're proposing is this drop in the federal exemption. If it goes into effect, it will go into effect as of January 1st of 2022. So it could go into effect pretty soon here. So again, we're still unclear as to what that drop would be, if any. So kind of, if you're so inclined, let us know, and we'd be happy to keep you up to date as we get new releases of information, or again, keeping an eye on the news, because again, I'm sure those numbers will be published as soon as they're finalized. So that proposed decrease, I should also say, at the federal level wreaks some havoc on the Connecticut estate tax exemption, just because I mentioned right now Connecticut 7.1, next year's 9.1, in 2023 it's supposed to go up to be north of 11 million. The reason I don't quote a specific number for 2023 exemption and just say north of 11 million is because under the current Connecticut system, that $11 million really, the language that is used is saying that at 2023, the Connecticut exemption is intended to match the federal exemption. So now with this proposed reduction of the federal exemption, it is also not only unclear what that reduction at the federal level is going to be, but how that is going to wreak havoc on the Connecticut system. So it could mean if this new legislation is implemented, not only is there going to be a change in the federal law, but Connecticut now might have to revisit their own legislation to see if there's going to be an adjustment, whether Connecticut decides to continue to increase their exemption, so it's still going to be 11 million regardless of the federal, or if they're going to drop back down to keep pace with the federal exemption. Again, all of it's kind of unclear at the moment, and we're trying to keep abreast of the most recent information, but again, nothing has been finalized up at until this point. As to state estate taxes, it's also important to note that the rules I'm giving you today is only specific as to Connecticut. Every state has their own rules. Many states do not have a state estate tax, so there's only a concern of whether you're going to be subject to the federal estate tax. And some states do have estate taxes, but the exemptions amounts are much different than Connecticut's. Connecticut's state estate tax exemption is fairly high, particularly in comparison to most states that have an estate tax. So for example, Rhode Island has an estate tax where the exemption is just about 1.6 million. Massachusetts exemption is only 1 million. But then there's states, as I mentioned, that have no estate tax at all. So in New England, New Hampshire is one of those states, there is no estate tax. If you're considering moving down to Florida, that's going to be really beneficial for you too, because there's no estate tax in Florida. So just something, again, to be mindful of, that all the states have their own separate rules. Not only to, if it wasn't complicated enough as to worrying about where the estate taxes are, there's about, I think, 7 states or so that also have an inheritance tax. And to give you an example, I think in this area, New Jersey, Pennsylvania, Maryland all have inheritance taxes, which means your estate may not be paying a tax, but the people you're leaving the money to may be subject to a tax. And that's a big exception to the general rule that, and this is something I'm going to get into in a minute, generally beneficiaries don't pay taxes on inheritance. And the one big exception to that, and again, there's some other exceptions, which I'm going to get into in a moment, but the big exception, again, is for those states. If you move to a state where there is an inheritance tax, your beneficiaries then may be paying a tax on that inheritance. So again, just be very sure that you understand the specific rules of the state you're living in. And again, I'm going to be focusing pretty much primarily on Connecticut. So if you have questions about other states, you can feel free to let me know. Or again, if you're thinking of moving to that one of those other states, make sure you do your research and just try to nail down what the specific laws are in those states. So that's on kind of mostly, and again, I veered into taxation of beneficiaries of estate towards the end there, but generally the whole estate tax system is geared at your estate. If you pass away and you own a certain amount of assets at the time you pass, your estate may owe a tax. So whenever somebody asks me, is there going to be a tax in regards to my estate, in regards to inheritance, that's always the first issue I address, is that there is an estate tax, both at the Connecticut and federal level, that exists. But again, I don't want anyone to lose a whole lot of sleep over it just because the tax is largely inapplicable just because of the high exemption amounts. As to your beneficiaries, so I mentioned the one big exception to the general rule that beneficiaries do not pay a tax on inheritance is one if you're living in a state where there is an inheritance tax, but again, Connecticut is not one of those states. So for Connecticut purposes, do your beneficiaries have to pay a tax on inherited assets? Again, generally speaking, no. If they're inheriting, your beneficiaries are inheriting your house and your bank accounts and your cars, the initial receipt of that inheritance is not taxable to them. Even if you had a taxable estate where you left your beneficiaries $20 million, there may be, again, that tax paid by your estate at the state level, but your beneficiary who inherits 20 million doesn't have to pay taxes on it. One exception to that rule is there is some income tax implications for inherited qualified retirement accounts. And when I say qualified retirement accounts, I'm specifically referring to pre-income tax dollars that have been in certain accounts. So 401ks, IRAs, 403bs, all of these are qualified retirement accounts where essentially you haven't paid any income taxes on the funds in those accounts. When you were getting paid, amounts were either put in there directly by your employer or taken off the top of your paycheck and just put into this account without you have ever having to account for those funds on your income tax returns. The perk for doing this, or I should say one of the biggest benefits for doing that, is again, now those amounts continue to sit and grow in that account tax-free. You don't have to pay any taxes on those accounts until you start withdrawing money out. So right now, the current legislation in place says that you are not required to start taking distributions out of 401ks or IRAs. And again, I call them IRAs just as a general term, but I'm really referring to any type of qualified retirement account. You're not required by law to start taking distributions out of those accounts, what's known as required minimum distributions or RMDs, until you turn age 72. You can take them out earlier, again, post-retirement, before reaching age 72, but the IRS says you're not required to start taking money out of those accounts until you turn 72. When you turn 72 and start taking money out, you're, again, going to be taking out those required minimum distributions, which is an amount that's determined by the IRS. And it's really a fraction of your life, based off of your life expectancy, I should say. So if you're age 72, the IRS has all these tables that say we estimate you're going to live another 20, 25 years. So then you take out 1/25 of your account at that time. The next year they say, well, now we think you're only going to live 24 more years. So you take out 1/24. So that's how they calculate what that RMD is. So during your lifetime, while you're taking out those RMDs, you then would pay income taxes on the amount that you're withdrawing from those accounts. Again, just because income taxes have never been paid on those monies. Same rules are going to apply to anybody who inherits those qualified retirement accounts. So if you leave the IRA to your kids or to other beneficiaries, when they inherit those accounts, those are, again, still, as they now then take distributions out of those accounts, they are now the ones that are paying the income taxes on those distributions. So do beneficiaries generally, again, have to pay inheritance on a tax or tax on an inheritance? No, with the exception of these qualified retirement accounts, just because anybody who's taking withdrawals from a retirement account, whether it's in your IRA or whether it's an inherited IRA, have to pay income taxes on those fees, on those amounts. I should note that there was recently, and when I say recently, I mean January 1st, 2020, a big change in the tax laws concerning inherited IRAs, so inherited qualified retirement accounts. And that's because the rule prior to January 1st, 2021 is that your beneficiaries, in most cases, had to take RMDs out of those inherited IRAs, the same as you, but the amount of the RMDs those beneficiaries were required to take out were based off of the beneficiary's life expectancy. And this was a really great tax result for those beneficiaries, because if you were age 72 or 75 or 80 when you were taking your RMDs out of the account, it was a pretty large fraction of the account that you were required to take out, because the IRS says we don't expect you to live much longer. Your beneficiaries, on the other hand, are, if they were much younger than you, if you left your IRA to a 30-year-old, the RMD that they then have to take out is based off of their life expectancy, which is much less. So they're taking out just a small fraction of that account, which again lets the balance continue to sit there and grow in interest without having the beneficiary have to pay taxes. So again, the beneficiary got to spread out that tax bill over the course of their lifetime. So it wasn't, again, it was a more beneficial tax result for the beneficiary. January 1st, 2020, the Secure Act went into effect, which rewrote all those rules and essentially said that any beneficiary, and again, with few exceptions, inheriting a qualified retirement account, or that again is going to receive an inherited IRA, no longer can stretch out those distributions, those RMDs, over the beneficiary's lifetime. They have a flat 10-year period. From the date you pass away and they inherit that IRA, they only have 10 years. And the IRS is actually still issuing guidance on this, but last that I saw, there was no requirement that RMDs be taken by the beneficiary. So it's not like they have to take out 1/10, 1/10, 1/10 each year. Theoretically, they could wait until the 10th year and just withdraw it all then. But again, the ultimate cutoff is they have to withdraw it all within 10 years. So they no longer get what we call the lifetime stretch, again, RMDs based off of the beneficiary's life expectancy, which really means that the government is getting the taxes on those funds quicker. So just something to be aware of. Also keep in mind too, any IRAs or qualified retirement accounts that were inherited before 2020 still get the benefit of the old rules. So if you inherited an IRA from a parent or from someone else prior to January 1st, 2020, you still get the option potentially of that lifetime stretch. So those rules are still in effect again for any IRAs inherited pre-2020. Also, because of the changes that were implemented under the Secure Act, again, with that new 10-year rule being in effect, it can be detrimental to any current estate planning documents that you might have in place. And the big one I'm thinking of is we have numerous clients who set up trusts to say that, well, when I pass away, the money goes to my children or again, other beneficiaries, but not outright. Those funds are to be held in trust, and the trustee is going to dole the funds out periodically over a period of years or under the various rules that they established. Those types of trusts can now be problematic if those trusts are going to be receiving an inherited IRA. Because again, even if a trust was set up as a beneficiary of these IRAs, and again, presuming it's I'll say the right kind of trust. So what's known as a conduit trust was pretty common for us to establish, which meant that the trust could be named as the beneficiary of an IRA, but for tax purposes, it's still going to be treated as if the actual individual beneficiary of the trust was named as the direct beneficiary of the IRA. So you still get the benefit of that lifetime stretch that I mentioned. But in order, again, for those rules to apply, what had to be included in the trust was that still, when those RMDs are taken out of the IRA every year, they had to be distributed immediately out to the beneficiary of the trust. It used to be not that big of a deal, again, because particularly when we were dealing with younger beneficiaries, if it's a 30-year-old or a 35-year-old, the RMD that they would be required to take out of those inherited IRAs was probably relatively small. So the fact that amounts were flowing directly out to the beneficiary, and really the vast majority of the assets could be still retained in trust and still managed for the trust beneficiary's benefit, it was a system that worked well. Under the new rule, with, again, the mandatory 10-year rule, it may, again, if you still have those conduit trusts that says any distributions that come out of those IRAs are forced to be distributed directly out to the beneficiary of the trust, that may mean that beneficiary is all of a sudden getting a lot bigger check in their hands than maybe what you had initially intended. So if you have $1 million IRA and the trustee and it goes into a conduit trust, all of a sudden the trustee may be flowing out. If they're taking out 1/10 each year, if they choose to go that route, all of a sudden your beneficiary is getting $100,000 dumped into their lap every single year. If the reason you set up this trust is because you have a beneficiary who's really bad at managing money, that may be a pretty bad result and essentially upends the plans that you put in place. So I mentioned that simply to say that if you have trusts in place that you had implemented pre-2020, you probably are going to want to go back, take a look, see, is it a conduit trust? Because if so, maybe we update the trust to switch to another type of trust that's called an accumulation trust, which means there isn't that mandatory distributing out any amounts from the inherited IRA. The trustee isn't mandated to do that. So again, you can achieve your goals still in making sure you're protecting that inheritance for your beneficiary who may not, again, be good with managing money or have creditor issues or other implications there. So make sure you're looking at any pre-2020 estate planning documents just to make sure they're not going to be detrimentally affected by those new Secure Act rules that went into effect last year. Another income tax component is for sale of appreciated assets. So one of the best examples I like to use is real estate. So because I find it's just very easy to paint a hypothetical picture. So to that end, the hypothetical picture is you pass away, you leave your house to your kids. Any assets that are inherited by a beneficiary due to your death, the beneficiary is going to get what's known as stepped up basis, which is going to achieve a really good tax result for them. And I'll explain why. The whole concept of basis is it's a tax term that really says basis, your basis in an asset is what you paid for it. If you bought a house 10 years ago for $150,000, your basis in the house is $150,000. If 10 years later, that house is worth $250,000, there is $100,000 worth of gain that has occurred. So if the house is sold, and again, there's general exceptions to this rule, but simply for our hypothetical purposes, if you then sell the house that you bought for 150 10 years later for 250, you're going to have to pay capital gains taxes on that $100,000 worth of appreciation. So again, so that's kind of the concept of basis. But the government gives you a break when they're inherited assets. So if you inherit, you're a beneficiary where you inherited mom or dad's house, and mom and dad bought the house years and years and years ago for $100,000. When you inherit it and it's now worth $300,000, let's say, there's $200,000 worth of gain in there. But again, that break that the government gives you is stepped up basis, which what it is they say your basis, you as the beneficiary, your basis in the property is going to be stepped up such that your basis in the property is now going to be the fair market value of the property as of the date the person you inherited the property passed away. So when mom and dad passed away and the value of the house was the fair market value of the house was $300,000, your basis in the house now becomes $300. So if you then turn around and sell it for $300, you have no gain. Even though mom and dad's basis in the house was $100, again, all that gain is wiped away by this concept of stepped up basis. So it's going to provide a really beneficial tax benefit for you. Again, if you're inheriting that real estate, or again, if you're leaving real estate. And I use real estate as an example, but stocks and bonds or any other types of investments can get stepped up in basis too. It is applicable to other types of assets. So, but again, I'm just using real estate as an example just to simplify things. So stepped up basis, again, is going to wipe away a lot of that gain. However, in that same example, mom and dad bought a house for $100,000. Their basis in the house was $100,000. As of the date they pass away and leave the house to you, it's $300,000. Your basis in the house is $300,000. You then say, well, I'm going to hold on to the house for a little while, maybe because it's, a great vacation place that mom and dad left, has sentimental value, or maybe I'll rent it out again, whatever you decide to do with it. If you hold on to it for a period of time, let's say 5 years, and then 5 years down the road, the fair market value of that property is now $400,000 and you go to sell it, your basis is still the fair market value as of the date of mom and dad's death. So your basis was $300 when mom and dad died. You then sell it for $400. There is going to be capital gains now that you have to pay. Granted, it's only on that $100,000 of appreciation that's happened since mom and dad's death. So again, that initial basis, or I should say that initial appreciation that occurred during mom and dad's life is still wiped away. But again, since the value of the property hasn't appreciated in value since you inherited it, there may still be some taxes that you're going to have to pay on that asset. So always be mindful, again, of the whole stepped up basis concept. That was another thing under the proposed legislation that's going through at the federal level right now. One of the initial proposals said to do away with step up in basis. It looks like for right now, they've gotten rid of that. So we're going to be keeping stepped up basis. But again, we're keeping an eye on that just to make sure that continues to be the case. Last but not least, I'm going to say a very quick word about the gift tax, which I know doesn't seem like it applies to inheritance, but I'll get into the specifics of why it's still related. So if you, instead of, in my example, mom and dad died, you inherited their house. If mom and dad instead gift the house to you during your lifetime and then they pass away, your basis in that house is not stepped up basis. So mom and dad bought the house for around $100,000. They gave the house to you a year before they died. And then when they died in 2021, the fair market value is $300,000. You got mom and dad's carryover basis because it was a gift, not an inheritance. So you get mom and dad's basis. So mom and dad's basis was $100,000. They gifted it to you. Your basis is $100,000. So if you then go to sell it after mom and dad die, all that appreciation that occurred during mom and dad's lifetime, you're going to be paying the taxes on that because it isn't wiped away. Again, there's no stepped up basis there. So something to be mindful of too when you're talking about lifetime gifting. Also too, the gift tax system in Connecticut is tied with the estate tax. So as I mentioned, Connecticut has an estate tax exemption currently of $7.1 million. If you're making gifts during your lifetime, there is the gift tax to be worried about, which under the gift tax system, the IRS says you can give up to $15,000 per year per recipient. And you don't have to tell anyone about it. You don't have to file a gift tax return. You don't have to let us know about it. As long as you stay at $15,000 or under, it's essentially free for tax purposes. And as married couples, that actually means you can give away $30,000 per year to one person because husband and wife each have their own, or each spouse, I should say, has their own $15,000 free annual gift exclusion. If you give more than the $15,000, which you can do, so a lot of people say, no, I can only give 15. Well, no, you can give 15 free, but you can make larger gifts. And if you do, then that's going to trigger the requirement that you will have to file a gift tax return to report the value of the gift. And when you file that gift tax return reporting the value of the gift, the good news is that you may not be coming out of pocket to pay that gift tax to the state or to the federal government. Again, because the estate tax and the gift tax systems are tied together. So they say, instead of you paying us for the gift tax that is owed on this taxable gift, so that gift you made that was over $15,000, instead, what we're going to do is we're going to reduce the amount of your available estate tax exemption. So if you made a gift that's resulting in $100,000 worth of gift taxes, instead of having a $7 million estate tax exemption, we're going to reduce your exemption by the amount of the tax due. So now you only have a $7 million exemption. Again, to a lot of folks, I always say no harm, no foul, because if you don't have assets anywhere near the estate tax exemption, it really doesn't matter if they're going to reduce your exemption because you're not going to be near that limit anyways. But again, I bring it up in a this tax seminar here because I said estate tax is going to be a potential tax you're going to have to worry about at your estate level when you pass. So just be mindful of, if you do have a substantial amount of assets that are somewhat near or going to be near that estate tax exemption amount, but you've also done a substantial lifetime gifting, your available exemption may not be 7.1 or 9.1, or again, whatever the exemption is in that current year. It may be less because you may have taken advantage of it by making larger lifetime gifts. So again, that's the only reason I just wanted to quickly mention the gift tax, just because the gift tax system does have some implication as to the estate tax system. So that being said, I wanted to thank you guys all for attending. I hope you found this information beneficial. I do want to give folks to type in any questions they might have into the chat. So if anyone wants to ask a question specifically about something that I mentioned during the webinar today, or something that you may have just heard generally from a friend or from a news article or some other source and wanted to ask me again, please feel free to type that that question into the chat section. And I don't see anything popping up right away, but I'll give you a minute here. Again, if you do have any questions, please take the time to type that in. Alternatively, if you don't have a question now, but maybe have a question later on, again, please feel free to go to our website and get our my contact information and contact me directly with those questions. I'd be happy to email you back, or at least, or also maybe give you a quick phone call again to walk through the answers to your specific questions. So again, I don't see any questions popping up in the chat right now. Oh, and actually I do. Here's a question that we have here. That says, what is the percentage rate for tax for at the federal level on a decedent's estate tax? So the highest possible tax bracket is 40%. So it can be pretty substantial, but it's an escalating rate. So if you're only slightly over the exemption amount, it's a lower tax rate. If you're several $1 million over the estate tax, that's when you're going to hit the maximum tax rate. So again, it's kind of a graduated scale depending on how far over the estate tax exemption amount your estate is. Another question that just came in is the tax based on the beneficiary location. So for the estate tax that is applicable to your estate is based off of the state that you are living in. For the income tax consequences that I mentioned for the qualified retirement accounts and such, yes, that's entirely going to be dictated by the beneficiary's income tax implications that are instituted in the state they are living, or at the implications at the federal level. So it's all dependent upon that specific beneficiary's tax bracket, and again, whether they're living in the state where there's an estate tax in addition to the federal estate, or federal income tax in addition to state income tax, I should say. All right, so I don't see any other questions coming in. Thank you guys again for signing up today. Oh, and just as I said, of course, there's another question. I'm happy to answer that. So let's just see. The question is, my parents quitclaimed their home in 2008 to us 3 kids, but it gave my parents a life use. My dad recently passed away and was the second to pass. Will the kids get a stepped up basis? Yes. So that's kind of the one exception to that lifetime gifting rule, where I mentioned for lifetime gifts, you don't get stepped up basis. You do still get the stepped up basis if the person making the gift retains some interest in the gift. So specific to this instance, where the home was gifted, but the parents retained a life estate, which means the parents gifted the house, but they retained the legal right to continue to live in the house. In that instance, when they passed away, they still retained an interest in the property. So upon the second death, when the kids now own the house free and clear, not subject to mom and dad's life estate, the kids will get a stepped up basis in the property. So that's another way to configure it. If you are thinking about lifetime gifts, or parents are thinking about making a lifetime gift of the house to you, sometimes that retained life estate makes a lot of sense. For exactly that reason. There's some other components there too, which I'm not going to get into right now, but it can have a really beneficial result for tax purposes. All right, wait one more second here just to see if any other questions come in, but I want to say thank you for your questions. They're really good questions. And that's why I always like to give folks a chance to ask, because I give these types of seminars and give very basic information, but I know everyone's situation is a little bit different. You may have something very specific on your mind. So thank you for submitting your questions. I always want to make sure everybody's getting out of the seminar what they really had hoped to get when they logged on today. So that being said, I don't see any other questions coming in. So again, thank you all for signing on for the webinar today. Please check out our website for future webinars that we have coming up. And also too, please feel free to check out our website. All of our prior webinars, in addition to today's, will be added to, the recordings are added to our website, so you can view those webinars for any past information that we may have provided. So again, thank you, and I hope to see you all on future webinars.